23 times and counting. Hungary's central bank cut its main interest rate to a record low of 2.3% on Tuesday and said rates may still have not reached the bottom. Gergely Gabler joins me down the line to discuss. Gergely, Hungary now has the second lowest interest rate among Central Europe's non-Eurozone countries, even as it looks to roll over the region's highest debt pile with a junk credit rating. This may make it more vulnerable to market shocks, but do you think Hungary can retain investor faith?
I think they already did, actually. If you look at the money markets, we can see that the bond yields dropped significantly this year and the last year. Now the 10-year bonds are trading at 4.49%, which was 150 basis points higher in this January, and actually it was halved during the last 2 years. If we look at the real economy investors, of course, the investment faith did not really come back because our investment ratio is still very low, around 18%. But as for the financial markets, I think the investors now do not rate Hungary to a junk category. Only the rating agencies do.
Many other central banks are running the rate hike race, so to speak. So the NBH really is bucking the trend. But do you believe this is the right course of action for the Hungarian economy at present?
Actually, it's quite risky at this level because 2.3% is, in my opinion, is too low for Hungary with such a high external debt and such a high public debt. But for now, until the global liquidity is this good, this fits the Hungarian economic policy. We have to note, by the way, that this does not really help now the Hungarian economy in that point that the lending activity is still very low from the banking sector side. This has two main reasons. The first reason is that the banks are hit by several levies from the government, for example, the banking tax. So the ability for the banks to lend the economy is very low, and they can only do it at a high interest rate in spite of the very low central bank rate. The second part is that the willingness of companies, corporations to borrow money from the banks is very low, given the very low willingness to invest in Hungary, which is in connection with the uncertainties about the economic policy and the economic environment.
The Economy Minister has said economic growth could exceed 2.5% this year, unless the conflict between Ukraine and Russia escalated and hit key industries. But where would you say the main risks could emanate from?
Regarding the Russia-Ukraine crisis, I would say that this has only a marginal effect on the Hungarian economy. The main effect it can have, the main negative effect, comes from the financial markets. So if the financial markets become uncertain about this crisis and become less willing to take risk, that could hit Hungary quite hard because Hungary is still very keen on external financing.
Now, Gerry, I understand you believe the low base rate does carry significant financial stability risks, as Hungary is very sensitive to the foreign exchange rate because of this external debt. But what is your outlook for the Hungarian forint against the euro as the ECB embark on their own unconventional policy path?
Despite the low interest rate environment and despite the economic policy uncertainties, I still believe that the forint has quite good outlook for the future. So I don't believe that it would depreciate too much against the euro, given that Hungary has an enormous high external financing capability from the current account surplus and the capital account surplus. The current account surplus was 3 billion euros last year, and adding the 3.5 billion euro capital account, Hungary's external financing capability amounted to a never-seen 6.5 billion euros. So this helps to offset the risks from the low interest rate environment and the deleveraging of the external debt that weighed on the forint during the last few years.
Gary, thank you so much for your time and insights today. It's been a pleasure speaking with you. Well, viewers, for more currency outlooks, make sure you click back for the midweek edition of Forecasts. But for me and for now, it's goodbye.